Good morning. We're looking at the monthly, I call it the Kiwi. It's the New Zealand dollar. You know, being a bank trader, you do get to know these different currencies by their different names. But obviously, the retail market, Kiwi, is New Zealand dollar. So, we're looking at the monthly chart. I like Kiwi. I've got to say, you know, we've come up, or we've come down, but you're holding this area around here on the monthly charts. And I will stress that to be a profitable trader, a consistently profitable trader, you need to look at these longer time frames. Because if you don't know where the primary and secondary trends are, you're not going to know the direction of which the outside world is looking at these markets. And they're looking at the Kiwi, and it is looking to go higher. We're up already this morning. We're trading at 67.77. So, you know, we are, if we open up here, we are looking at the market trading up to this 9-month average, and that is at 68.52. Now obviously up here you've got a lot of resistance, but let's just go on the fact that the monthlies look bullish, and then we can scale it down and look at the other time frames. So I'm going to now have a look at the weekly chart. Now if we take a look at the weekly chart, you can see the base. You can see that we've gone up through all of the weekly moving averages. The 55 we've gone up through, and we've gone up through the 21 and the 9-week moving average period. Now obviously up here, if you see all this, you've got the adaptive moving average up there weekly, you've got the 200 weekly period moving average, that's coming in at 69.34, and that trend line there this week is at 69.02. So just bear in mind all these things that are there as resistance up if the Kiwi still keeps going. We are overbought on the Kiwi, but that doesn't really mean anything if the market is starting to trend. At the moment, we are showing no sign that these are turning. But if they do start to turn, I still think that going on the monthly and the weekly charts, if we get down to this area here, which is going to be around 65.98, and that's where we want to be buying this market. So now let's look at a daily chart. Slightly overbought. Stochastics are looking to turn lower in a minute. The MACD still shows higher. Your RSI has turned off of the overbought condition. So we'll just keep our eye on that RSI. But look, you've got the double top here. Well, it's not a double top pattern. It's the fact that the price has not been able to get above 67.90, 68. If we do, we can go up to here, and then we look across. We look across at where we can possibly go to. So if we do break this area, you can see that automatically this is the area that we will be looking at. So you've got a double top on the daily chart that pushed it down. You've got a double bottom on the daily chart that's pushed it up. So it's all about timing. I've put the Fibonacci levels on there for you. So if we do come back to around this area here, the 38.2, you're going to see these ease and possibly even go into oversold conditions. Now, before I go on this, I just want you to take a look at the Aussie Kiwi cross. Now, this is a monthly chart of the Aussie Kiwi cross. You can see quite clearly we've broken down. So what that in effect means is the Aussie is going to lose ground against the Kiwi. So if you're trading any of these against the dollar, just remember that if you're doing Aussie dollar or Kiwi dollar, just remember that you've got more potential to go into the Kiwi than you have the Aussie. So what this cross says basically is sell Aussie, buy Kiwi. Okay, very good market, one of my favourites, one I trade quite a bit, and I always notice that, you know, you get up to around this area, it's a sell. And when it gets below this, okay, it's a sell. Now, although we've got this support at 104.30, we've got this at the bottom, which is 102.76, okay? But this would be the area that we're looking at. And that is down here at the lows. You're looking at 102, you know, quite a long way. 100, not parity exactly, but not that far off of parity. I think that low was like 100.21, so we need to hold above parity. So I think everyone's going to come out at that 100 level. One, because it's psychological, and two, it's stopped there before. We know history repeats itself, and there's no reason why it shouldn't do it again, okay? Now also you're looking here at the yearly lows of 102.79. So just keep that in mind, that's your yearly low, and markets do generally gravitate towards the yearly highs and lows. All right, take care, and I will catch you this afternoon.